Hi students, welcome to my class Accountancy Simplified. In today's class, I once again discuss the concept depreciation. In last class, I discussed about the definition of depreciation, its causes, its inputs, and name of different modes of charging depreciation. In today's class, I shall discuss in details the different modes of charging depreciation. I have already told in the earlier class that there are different types of methods through which depreciation of an asset can be charged in the annual accounts depending on the nature of business and the use of the asset in question. The first one is straight line method or fixed installment method. Under this method, depreciation is charged in an accounts in respect of each asset as a fixed amount. That's why this method is called straight line method. Depreciation under this method is calculated with the formula that original cost of the asset plus installation charges minus salvage value is divided by the estimated useful life of that asset. The resultant figure is charged as depreciation for each year. This is straight line method. The next one is reducing balance method or diminishing balance method. Under this method, depreciation of 1 year varies from the another year, and the depreciation of the last year is lesser than the starting year. The amount of depreciation gets reduced with the passage of time, as depreciation is charged with the reduced value after charging depreciation from the cost of the asset. The first year, say, the cost of the asset is 10,000 and depreciation is charged at the rate of 10% per annum. So in the first year, the amount of depreciation will be 1,000. If we deduct 1,000 from 10,000, the closing balance of the asset will be 9,000. In the next year, the opening balance of that asset will be down 9,000 and we will charge 10% of 9,000. The result will be 900. So in the first year, depreciation was 1,000 and the second year it comes to 900. So it gets reduced each year. As the depreciation gets reduced each year, this method is called reducing balance method or diminishing balance method. The third one is revaluation method. This method is used in respect of assets the useful life of which are very short. Under this method, all those assets are revalued at the end of the year and the resultant value is compared with the opening balance of that asset and the difference is charged as depreciation. This is very simple. The third one is depletion method. This method is utilized or used in respect of assets of natural resources like mines, quarries, etc. The next one is machine hour rate method. Under this method, depreciation is charged on hourly basis. The total cost of the asset minus its salvage value is divided by the estimated working hours of that asset. Resultant figure is depreciation and that amount is charged to annual accounts. The next one is depreciation fund method. Under this method, For each year, an amount of money is appropriated out of profit and invested outside the business in high yielding secure interest to arrange for the cost of replacement of the asset when the asset will be replaced in future. This method is called depreciation fund method. In each year, an amount of money is set aside out of available profit and invested outside the business in high yielding interest to arrange for replacement cost of that asset in future. This method is called depreciation fund method. The next one is annuity method. Next one is insurance policy method. This method is in line with the depreciation fund method. The only difference is that it is the amount of investment is made with the insurance company. Otherwise, the concept is same as that of the depreciation fund method. The last one is annuity method. Under this method, investment of the cost of the asset is regarded as investment, and at a given rate of interest, the interest is also considered. It is assumed that if the asset would not have been purchased by the trader of the company, this amount would have been earned by the company and the capital of the company would have been intact. By purchasing that asset, the company has lost its capital as well as interest. So depreciation is charged in such a manner with the help of the annuity table that the amount of capital and the interest thereon is recovered in the years to come. This method is called annuity method. So these are all about the different types of methods of charging depreciation in the annual accounts of any business entity. So that's all for today. Before I end my class, I would once again request all my students, my listeners and followers to subscribe my channel and share and like my channel for better distribution of my videos among the students of commerce community. Thank you. Goodbye.